Whoa! 9% only comes from corporations? So you're telling me corporations only pay 9% of the total tax while individual income tax is higher? If you don't understand bonds, you don't understand money. Now, before y'all jump ahead of the, you know what I'm saying? No. I don't understand bonds as good as my dude, Keith D do. So we about to tap into him. No. We was not about to do what you think I was about to do. I was not about to do that. But let's tap in and learn some bonds from my boy. It did.
There is a market worth over $100 trillion that impacts your mortgage, your job prospects, your stock portfolio, and even the price of Bitcoin. The reality is a lot of people don't know how this market works. No, it's not stocks. No, it's not crypto. It's actually the bond market, and it's the most important piece of the global financial system. So what is a bond? Imagine you're starting a business. You've got an amazing idea. You've got all the drive in the world to make it happen, but you just don't have the money. So you go to someone who does, and you borrow it. You make them a promise. You say, hey, I'll pay you back, and I'll give you a little extra on top.
So basically what I'm getting from this is bonds is basically credit. It's basically like loaning money. So that's what bonds is. Bonds is just loaning money, okay? All right, credit.
That little extra on top is called interest.
Interest.
That is the cost of using someone else's money. $1 today is worth more than $1 tomorrow. Because if you have $1 today, then you can use it to take advantage of opportunities as they arise.
Facts.
When someone gives you that money now, they're giving up that potential. So they want to be compensated for that. Because otherwise, they could have taken that same money and invested it in their own business or some other opportunity or even something like the S&P 500. Now, people and companies often borrow money, but so do governments. And when a company or a government needs to borrow money, they do it by issuing bonds. That makes them the borrower or the issuer of the bond, and the investor is the...
So the borrower also issues the bond. So is this just for bonds, or is this like any credit? Like if I'm getting credit, do I issue the... No, that can't make sense. So I guess just like, governments and corporations.
The U.S. government is always spending money, whether it's on defense, roads, healthcare, or social security and beyond. And while a lot of that may sound altruistic, in reality, it's also strategic. Governments spend to stimulate productivity because productive citizens and businesses generate tax revenues. Let's
run that back.
It's also strategic. Governments spend to stimulate productivity because productive citizens and businesses generate tax revenues.
So basically, governments spend to increase productivity because then productivity means more money. More money means more tax. So basically, they just spending to get more money. It makes sense, but it's like, damn.
Government's revenues are going to come from taxes. So in the United States in 2022.
So basically, the government's money either comes from taxes or bonds. That's where they get their money from. Taxes or bonds.
54% came from personal income taxes. 30%.
Whoa! 9% only comes from corporations? So you're telling me corporations only pay 9% of the total tax while individual income tax is higher? Wow. Learn tax write-offs. No, I'm playing, but that's crazy.
Came from payroll taxes.
That's crazy.
And 9% came from corporate taxes, while the rest was from excise taxes and things like park fees and so on. But here's the thing.
Park fees.
The U.S. government tends to spend a lot more than it collects in revenues.
Yeah, that sounds about right.
The gap between what they collect and what they spend is called the budget deficit.
So instead of the government being minimalist and, you know, lowering their expenses, they want to outspend. So it's crazy because a person to get penalized for having a maxed out credit score, but you're telling me if the government got a $10,000 credit card, they spending $20,000, and we don't look at the government wrong? That's crazy. They spending more than they have, but we look that bad. You know what I'm saying? My credit score get a ding. But what about them?
And every time we run a deficit,
Whoa.
we're adding to the total national debt, which is the amount that the government owes from all past borrowing. Deficits are annual. The total debt is cumulative. The last time the U.S. government ran a budget surplus was in 2001.
So the last time we were spending less than we had was before 2001. And I'm assuming either before the dot-com bubble or before 9/11, which both happened in 2001, which is insane. So I guess the last time we were spending less than we had was before 2001. So ever since then, we have not. It's insane.
I find it surprising because it's a very different picture from where we sit today. In 2024, the U.S. had a $1.8 trillion deficit. So where does the extra money come from? The U.S. Treasury borrows that money from the public by issuing bonds. As the government needs cash, the Treasury holds auctions, selling bonds to investors all over the world, and people tend to buy them. Banks, pension funds, insurance companies, even foreign governments, and also regular American citizens. Why do people show up to these auctions? Part of it is because U.S. government bonds are considered one of the safest assets in the world. The day that the United States defaults on its debt would be a day where we probably have much bigger problems to deal with.
Bro, if the U.S. defaults on debt, it's probably gonna be apocalyptic in the United States, probably the world, because everybody, even though they got talks of BRICS this and this bank leaving this and this country, I mean, right now, in this very moment, the United States is pretty much still, the foundation as far as now. But we see other dollars getting strong. Like, when we can look at Forex right now, you can see, like, the British pound is stronger than the dollar. It's steady rising over the dollar and stuff like that. So, we'll see. We'll see.
So let's break down some of the terms around bonds. First, you have the principal, which is the amount being invested or the amount being borrowed. Then you have the coupon, which is the interest payment, or the percent that you're going to receive on that bond on a yearly basis. Then you have
so the principal will be like, if you bought a bond for $1,000, the interest payment would be, if it was 1%, then that'd be $10 you'll be making per whatever. I guess annual. So if you make 1% annual, which would be a horrible rate in my opinion, but it's maybe because I'm young and I don't have $1 trillion to put in there. I mean, $1 trillion at 1% is what, 10 billion? Something like that. I don't know. 1 billion? Yeah, 1 billion. Something like that. 10 billion, I think. Whatever. It don't even matter no more at that point.
The maturity, which is when the loan is due or how long the investor has to have their capital tied up.
Definitely.
Finally, we have the yield, 12%. Which is the return that the investor gets from the bond. And the reason that this is different from the coupon is because the price of the bond can change, which then affects the actual return. Bond prices go up and down, but the coupon, the dollar amount being paid on that bond, stays the same. And so because of that, the yield can move up or down.
Okay, so basically it's talking like, if you like, for us, we are investors and stuff like that, right? Well, I'm a stock investor specifically. So when I first started investing into stocks, the biggest thing was like, oh, Verizon has this 8% dividend yield and all that, which is a dividend trap now that we know it, because it don't matter if Verizon gives you an 8% dividend yield if it's going down 8% every goddamn day. But anyways, I digress. Basically, he's saying like the lower the price of the bond drops, the bigger your yield is, because you're getting the same amount. So if Verizon pays you $8 a year on a $100 stock, that means you have about stop it. But that means you'll have 8% yield at $100. But if it went up to $200, which it probably never will, I mean, in this very scenario, if it went up to $200, then you'll be at a 4% yield. So that's basically what he's saying.
Based upon the price of the bond. If the price of the bond falls, then the yield rises. And if the price of the bond goes up, then the yield will decline. Let's say you have a $1,000 face value bond, and that bond pays 3%, which is $30 a year. A few months later, there are bonds that get issued at 5% for $1,000, so paying $50. The bond that you previously bought paying $30 is now less attractive on the secondary market. So the price may drop to, let's imagine, $900, but you're still getting that same $30 coupon on that bond. So now, if you take that $30 and you divide it by the current price of $900, now you're sitting at a yield of 3.33%.
Yeah.
The opposite is true if rates were to fall. In that case, bond prices would go up and the yields would go down. So where do these market-based interest rates go up?
So basically, when rates drop, price goes up because people are trying to lock in that rate. That rate. When rates go up, prices drop. All right? Yeah, rates go up, prices drop because they want to lock in a better yield. Yeah, facts.
And the yields
that makes
would
sense.
Go down. So where do these market-based interest rates come from? Treasury auctions are one piece of that puzzle. The government sells bonds on a set schedule, weekly, monthly, depending upon the maturity of the bonds that they're selling. And the yield at auction depends upon how much demand there is at that auction for these bonds. This is called the primary market. When new treasury bonds are auctioned in the primary market, the yield at which
Where you at, my guy?
they are
This is a
sold
voiceover?
becomes a benchmark. And investors in the secondary market look at this yield to reassess the value of their expectations.
Oh, all right. That was a
Already in
voiceover. I was like,
circulation. Investors are
hello?
constantly buying assess the mark.
Hold on, run
And
that back.
investors in the secondary market look at this yield to reassess the value of similar bonds already in circulation. Investors are constantly
Shit, I ain't gonna lie. That was a bunch of jibber jabbers to me. I ain't gonna hold you. I ain't gonna lie. We got to run. Hey, this is one of the videos you got to run back like 10 times. I ain't gonna lie.
buying and
I heard a bunch of shit.
selling based on their expectations. Will the Fed hike or cut rates? Is the economy speeding up or slowing down? Do we expect inflation in the future? These are the kinds of questions that bond investors ask themselves to determine what yield makes sense for them to lend their money out at. The result is that the market interest rates are really just the yield that global bond investors are demanding at any moment in time. It's all based on what they think the future holds. Now here's where things get interesting. Because if market rates go up, then the cost for the government to borrow also rises. Right now, the U.S.
So basically, wow. Oh, okay. So what a lot of people don't realize is that interest rates also affect the government as well. So when Jerome Powell gets on that stand, he says, "Good afternoon, everyone," and the market does this, or if he says like, "Hey, everyone," or something goes up, whatever the superstition is with Jerome Powell nowadays. But basically, Jerome Powell also affects the government. So if we have super high interest rates, that also affects the yield that the government has to pay on its bonds as well. Oh, okay. All right. So high interest rates also affects the government, which means they have to pay out more, which means that they will have less money.
government has over $36 trillion in national debt that they have borrowed from the public over time. The key ratio to watch to get an understanding of what that debt really means is called debt to GDP. It's a way to look at how much we owe versus how much we produce. It's kind of like how much do you have in your credit card balances versus how much is your annual income. This can
I was about to say GDP is basically like how much you make a year. So like we make $60K a year. If basically the whole government, like, okay, basically have the country of the United States. So the GDP of the United States would be how much everybody then made throughout that whole year, basically. Whatever the case.
Kind of give you a better idea of how healthy that debt is or how likely the person is to be able to pay off that debt within a certain period of time.
Facts.
But what's even more important is at what rate are we paying interest on that debt? Because when rates go up, then the government has to spend more just to cover the interest payments. And that burden can grow fast because right now, a lot of government debt is in short-term treasury bills. These treasury bills are constantly resetting because they mature in time frames like 6 months, 12 months, and 18 months. So the government is constantly using these short-term treasuries to fund their borrowing. This process is called rolling over the debt. What the government would like to do, as we're seeing in the news, is to get rates lower so that instead of using these short-term treasury bills to fund their borrowing, they can then lock in a lower rate for longer-term bonds like 30-year or 10-year bonds. When you want to borrow over a longer period of time, you want the rates to be lower. When rates are high and you borrow in the long term, it's like setting in your mortgage rate at 7%. Here's something that we have to think about. Every 6 to 12 months or so, we have these short-term obligations that the government is then refinancing again. But also, you have older borrowing that was done in the past over, say, 10, 30-year periods that's also now constantly coming up. The government is taking what was once long-term debt and rolling it over into these short-term maturities. And as that happens, more and more of the total debt burden is reliant upon present-day market interest rates. If rates were to rise, then so will
let's run that one back.
And as that happens, more and more of the total debt burden is reliant upon present-day market interest rates. If rates were to rise, then so will the cost of interest on the debt. And as that happens, it starts to crowd out the spending on other things like defense and health.
So basically what he's saying is, since all of the old long-term bonds that are starting to mature now, the government is rolling those over also into short-term bonds. The reason why this is a problem is because since interest rate is high right now, when those short-term bonds become a thing, they're at these high interest rates, which means that the government is having less and less money as we have all these high interest rates. So basically what the government needs to do to at least try to get the problem under control is to lower rates so they can start locking in long-term bonds, because they don't want to lock in long-term bonds at these high rates, because for the next 30 years you're going to be paying a 10%, 20%, just throwing out numbers here, but maturity. So they locking it all to these short terms so they don't have to pay 20% in theoretical 20% interest for 30 years out. So they're trying to pay 10%, 20% interest for the next 6 months, the next 18 months, and just wait for the whatchamacallit drop. Wait for the interest to drop. I'm putting wait for the interest to drop. So when the interest rates drop, then they go start locking it back. They go lock back into the long term so they can pay lower interest for long term. Basically what he's saying. I hope that makes sense to y'all.
If rates were to rise, then so will the cost of interest on the debt. And as that happens, it starts to crowd out the spending on other things like defense and healthcare.
Right, because they're paying so much back on interest that they don't have extra money to pay for chimpanzees landing on the moon and, trying to find the secret diamond on Mars and whatever they spend their money on. You dig? So
that sometimes will lead to cutting expenses or even continuing to borrow more heavily to find ways to fund these obligations. And that's why bond yields matter. Not only does it impact your mortgage, but it also shapes the financial future of entire countries. There's more to this that's going to impact your stock portfolio, so pay attention. When interest rates rise, government bonds essentially are offering a better return with no risk. Now, on the other hand, stocks are ownership in a company, not an obligation for a company or someone to pay you over a specific period of time.
Strictly
so if
ownership.
That business struggles, or even if the economy slows, then the price or the value of that stock can go down and even down to zero. Bonds are very different, especially U.S. Treasuries, because the only way that you don't get paid is if the government defaults. Otherwise, you're going to get your money back with interest. So when Treasuries start offering 5% and stocks have an expected return, let's say of 6%, then investors are going to ask themselves, am I really going to take the risk of buying a stock that's going to give me 6% when I can get a guaranteed 5% from the government? That interest rate for government bonds is called the risk-free rate. And the 1% spread between the expected value of the 6% from the stock market and the 5% from the government bond is called the equity risk premium. When bond yields rise, that premium shrinks. And as that happens, investors start to rotate out of stocks or sell them. Now, that
basically, if bonds has a higher rate compared to stocks, then bonds would be be a better investment, and the spread between that is called whatever term he just threw up on the screen. But long story short, it's like would I try to get one more percent out of the stock market? Well, I can get 1% less and have a guaranteed, as long as the country doesn't default, guaranteed return of this much, but risk my money going all the way to zero just for extra percent?
That was the equity risk premium, which is the difference between the risk-free rate from the government and what investors would need from a stock in order to justify taking that extra risk. You have a similar concept in the bond market, and specifically between government bonds and corporate bonds. When fear in the market rises, investors demand higher interest rates from the corporate bond market. Companies tend to have different credit ratings and a real potential to actually go bankrupt. The gap between safe government bonds and...
Oh, boy, I see that market wizards behind you. I see that market. Look at that market wizards right there. Just finished that bad boy. If y'all... oh, my God, I can't even talk. It's a gym, I swear. It's the gym that's making me feel like this. But if y'all into the market, stocks, whatever, I mean, obviously, if you're watching this video, you're into something. You need to pick this up if you've never read it before. That's going to change your life.
And risky corporate bonds is called the high yield spread. When that potential to actually go bankrupt. The gap between safe government bonds and risky corporate bonds is called the high yield spread. When that spread widens, It's usually a signal of some sort of trouble in the markets. The bond market doesn't just reflect economic reality, it also shapes it. Because as isn't just items.
Let's look at this again. I'm assuming every gray line was during recession. So yeah. Recession. So everybody always talk about the inverted yield curve, but the high yield spread could be another signifier of recessions. That's interesting. Okay. Keep this in mind. This .com bubble. Look like it peaked out here. It peaked up a little bit more. The high yield spread. Then it dropped back finally. Okay. So high yield spread on top of the inverted yield curve. That's two things we can look at for market recessions, whatever you want to call it.
It's usually a signal of some sort of trouble in the markets. The bond market doesn't just reflect economic reality, it also shapes it. Because as interest rates rise, it can start to slow down the entire economy. One more thing.
Right.
The yield curve. Normally, longer term.
And now I 100% understand. Thanks to Keith D, I 100% understand now. Interest rates goes up. People have less money to spend. The government also has less money to spend. So it tightens everybody's pockets. Everybody's pockets tight means they should, in general, be spending less. But this is America, so somebody always finds some money. But in general, people should be spending less, which means that this is why then companies like, well, you know, your companies start to go down in value because they're not getting as much money from revenue because people are not spending money with them anymore. At least that's what it should be. But as we can see right now, man, we've been having as far as I know, high interest rates for the last couple of years now. And the market is still at all-time high. Bitcoin fell down now until our buy zone. And stocks are still running. They're still near all-time highs. Right now, September 4th, 2025. It's still that high. So it's a crazy world we live in right now.
Bonds are going to pay more than shorter-term bonds because locking up capital for a longer period of time is going to have a larger opportunity cost as things continue to change.
So you want a higher yield.
Your money's tied up in a bond.
All right. So right now, the higher interest rate says the better it is to lock in. If you're a lender of money, the best time to lock in rates is now. But if you're a borrower of money, you want to be going with short-term debt. If you're a lender, you want to be going with long-term debt. But the opposite changes when the interest rate's lower. When interest rates are lower, you want to become a borrower and not a lender. Oh, if you're a lender, you probably want to be doing what, short-term or whatever. But yeah, long story short, yeah, when you're high interest rates, borrow short-term. When you're low interest rates, borrow long-term. Simple as that.
But when short-term yields are higher than long-term yields, then you have what is called an inverted curve. When the yield curve inverts.
And I would really say if you're high interest rates, don't borrow at all. But if you have to borrow short-term, guaranteed. Do not borrow long-term with high interest rates.
Investors are basically saying they prefer long-term bonds compared to short-term bonds because they're expecting either an economic slowdown or another reason for rates to decline.
So let's run that back one time.
They prefer long-term bonds compared to short-term bonds because they're expecting either an economic slowdown or another reason for rates to decline in the future. The increased demand for the long-term bonds pushes the yields of those bonds down. Later in this series, we'll talk about how the Fed and the Treasury interact with...
All right, so appreciate you that Keith D. Make sure I show my guy some love. He done taught me some game, helped me figure out, because I don't know why I never thought, like, of course the government is affected by high interest rates. I mean, it's common sense. But like they always say, common sense don't make no sense no more. So if y'all enjoy the video, let me know. And I'll do more like this, you feel me? But we definitely got to watch like 2, 3, 4, 5 times and get a nice textbook size notebook and write this down. Because, you know, this is a real game in here. But I'm going to holler at y'all on the next one. See ya.